Welcome back to America's Retirement Headquarters, home of the Retirement Guys formula and America's Medicare Associates with Nolan Baker and Chaz Price. 419-794-3030 is the phone number. The website, arhq.com. Guys, good news. Several stock market indexes are now up 25% or more from last year's lows. But of course, as we said many times on the financial channels, it's their job to be contrarian. And analyst Carter Worth recently told CNBC that just like gravity, what goes up must come down. And he thinks, well, down is where we're going to be headed very soon.
Why would we use the word correction unless the implication is that the preceding circumstance is incorrect, which is exactly what it is. If something gets too steep or ahead of itself, it needs a pause, a rest, a break.
Now, Worth is calling for a 9% correction in the next couple of months. What are your thoughts on this? Do you agree? And how are you helping your clients avoid that kind of loss, whether it happens soon or at some point in their retirement?
Well, we do have our economic summit that's coming up in October 11th, and that's probably one of our most popular events. People come out to that event because we talk about, our outlook on the economy and the markets. We'd love to have people come out to that event. But what you'll notice is one of the first things that I'll always tell people is what my opinion of the market is. But I also say, at the end of the day, the market doesn't care what my opinion is. So even in this example here, if somebody's quoting that they believe that there's a 9% correction coming in the next few months, they're probably right. I guess it just depends on how many months that will be. If you look at things and you look at the market, I'm so excited to see that there are so many indexes that are up double digits this year, some up more than 25%. When we look at this and we think about this, it refers back to in the context of how does this change the outcome of your individual financial plan? Sometimes it makes sense right now with the market being up so much to take some profits off the table. I'll give you an example there. My son Andrew, he invests in companies, and one of his computer companies is up dramatically this year. And Andrew asked Dad, he said, well, what should I do? When we looked at the stock, we did the evaluation of the stock. I also felt, based upon the valuations and looking at the numbers, the stock was actually a little overpriced right now. So my advice to him was to take some of his profits off the table, keep his original investment inside of there, but lock in some profits. By doing so, what it could do is it could give him some cash that he could use that to buy if there is, at some point in this example, a dip in the market. He could also use it if he wanted to pay down his car loan, pay off a debt, or he could use it to find maybe another opportunity in the market, something that would fit the criteria of what he's looking for if he's trying to find something that's maybe has more growth potential and is on a little bit of a sale. The other thing you want to do in this type of environment, this is so important, folks, is make sure that you rebalance your portfolio. You either want to rebalance your portfolio during set intervals, so maybe every 6 months is a good time to rebalance your portfolio. You also maybe want to consider rebalancing your portfolio when something happens outside of the norm. In this example, it's not normal that, 3/4 of the way through the year, most of the indexes or a lot of the indexes are up 25%. That's not normal. And so while the market is up based upon a percentage, so if it goes up more than 20%, that could be another reason why you'd want to look at rebalancing your portfolio. All in all, though, you still got to keep a long-term perspective, especially with the money that's been part of your plan, whether you're working with our firm or another firm. If there's money that's allocated that's your long-term bucket of money, meaning you're not going to need this for 5 or 10 years or 15, keep a long-term perspective, because if it does go down in the next few months, does it really change the long-term plan? Most likely not. It maybe is an opportunity to buy more. So you want to use that to avoid doing emotional trading. I had a gentleman that had come into the office, attended one of our seminars, and he came in after the event, and he was at a loss on what to do. And he was at a loss on what to do because, come to find out, in October of last year, when the market was going down and selling off, he called his advisor and had his advisor move his account to cash. And now he's sitting in cash. And since October, he missed the entire recovery that the market had. And it's gut-wrenching for him because he's trying to decide, do I get back into the market now because now I'm missing the rally? Or is the market going to fall and do I stay out? And, it's a tough decision.
It's like putting salt in the wound
It's
psychologically.
Yeah, and so if he does get in, again, the market doesn't care what my opinion is. If it sells off again, it's like a 1-2 punch to the gut, and even a bat to the side of the head is how I would probably feel in that situation. So you want to avoid that emotional investing. I mean, if you look at the market, a lot of the technical indicators in the market still show relative strength. We have a market where the S&P is above the 50-day moving average. The S&P 500 index is above the 200-day moving average. And some technical traders would say that shows that there's still relative strength in the market. But you could consider, if you wanted to kind of hedge your bet, you could consider investments that allow you to participate in gains if the market continues to go up, but they could protect you from losses. So there's investment vehicles like fixed index annuities that offer that type of protection. There's investments that are non-annuities, like what our strategy is called protected equities, that are shorter term, more liquid investments that still offer downside protection. There's ways to hedge your strategy. So folks, let's stress test your plan. If you're worried about the next drop in the market and what to do, let's talk. I'd be happy to run an independent portfolio analysis for you, show you where maybe there's some areas that it could be a good time to take some profits, show you where maybe you want to protect some of those gains, how it applies to your situation, and dive deep, roll up our sleeves, and kind of get in there and take a look at them. But when people are asking you, Chaz, about the market and your outlook, what are you telling investors?
Yeah, as you know, Nolan, one of the core sensibilities that I have as it pertains to retirement planning for retirees that are approaching or in the early stages of retirements, we've talked about it ad nauseum, is sequence of return risk. Sequence of return risk and limiting losses frequently early in retirement is probably one of the most important strategies that a retiree can use, because it's going to help preserve your retirement assets and help make sure that they last a long time. Sequence of return risk is the risk that you experience a negative or a low return in the early years of retirement. And so, for example, let's say, for instance, you had $1 million portfolio and you plan to withdraw 4%, standard 4% withdrawal, $40,000 per year adjusted for inflation for 30 years. So if you retire in a year when the market is down 10%, your portfolio, when your market is 10% up, your portfolio will grow to $1.06 million after your withdrawal. However, if you retire in a year when the market is down 10%, your portfolio shrinks to $864,000. So that means you just have less money to generate returns in the future on, which can significantly, limit your ability to have that money last as long as it needs to. So it's crucial that you frequently limit losses early in retirement. So I guess the answer to that question would be, is it time to rebalance the portfolio? What kind of depends on where that money is in terms of its time frame when it's needed. As you said, Nolan, is it long-term money? Is it short-term money? And that's the beauty of the independent income system, is that we go through several different iterations of that scenario. The how much are you going to spend and when? What's the market going to return? So we'll stress test the portfolio and those results in the market to see how many of them resulted in you having money left over at the end of the day. And so oftentimes the strategies and the clients that are most successful are the ones that don't experience downturns or negative market, significant downturns earlier in their retirement years. So I think it really comes down to where are you at in the life cycle of retirement? Is it early? Is it later in retirement? And when are you going to need the money? If you are approaching retirement, or you're in that retirement red zone, which is the 3 to 5 years prior to and into retirement, one thing, you may want to adopt a more conservative allocation at that point. It's going to reduce your volatility, help make sure that you're not exposed too much to the sequence of return risk. Make sure that you have, maybe increase the value of your stable assets, your bonds and your cash. It's a great time to do that right now. If you haven't, looked at our fixed income investments You've got interest rates, that we haven't seen in the last 20 years that you can get on a fixed basis, taking effectively very little risk, if at all any. The other strategy, again, like I said, you could do is more of a dynamic withdrawal strategy. So instead of the example above where we're just taking 4% off your portfolio, go through the exercise, go through a financial planning discovery phase with us and determine, what those cash flows are going to be and when, and then we can kind of back into that allocation so you can be confident to know, yeah, if the market goes down in the next 2 or 3 years right after I retire, I'm going to be okay because I'm not spending the money that's gone down, could potentially experience a loss. So not only that, from a financial perspective, limiting your losses frequently, kind of leading you down the path that maybe it does make sense to, take some risk off the table right now after a great year like we've experienced. But psychologically, I think it reduces stress. It reduces anxiety about retirement in general. You feel more secure about it. And, that's not to say we need to go all to cash or stay in the market 100%, but that's where the art form comes in. It's where our experience of having, 50 plus years or more experience just at this table here is going to help our investors be more successful because we've been in that movie before. So it's a balancing act. But I think it is something that you want to consider now, potentially taking some chips off the table, if you will, being a little bit more conservative, especially if you are early in retirement or approaching retirement within the next 3 years.
Because regardless of what your retirement dreams are, what the big picture looks like, I think something that is universal is having as stress-free as possible a retirement, being able to reduce that stress. And I believe everybody here on the show has at one point or another said, control what you can control. We can't control what the market is going to do. We can't control that sequence of returns when those market downturns are going to happen. What we can control, what you can control, is how you are equipped to withstand not just this market correction, but the one after that and the one after that. If you aren't sure how you are equipped right now, this is a good time to have that independent portfolio analysis, have that second opinion done, have a stress test run on your plan. And if you don't have a plan in place, well, almost certainly it's a good time to pick up the phone and give a call and schedule a time to speak with America's Retirement Headquarters. 419-794-3030 is the phone number. 419-794-3030. You heard Nolan mention the upcoming Economic Summit in October. If you want more information about that, including how to go ahead and reserve your seat on October 11th, go to the website, click on the events tab at arhq.com.